Well, hi everyone, and welcome to the Buffett and Beyond Research Stock of the Week. And this is October 4th, 2025, and we are into the last quarter of the year, folks. We're going over Eli Lilly, and folks, this stock has been up 500% in the past 5 years. Hasn't done so well this year, and this might be the buying opportunity. We're going to show you why. But remember, up 500% in the past 5 years, and where do you see their earnings? And remember, folks, if you want to live on this beach and have lunch like Jimmy Buffett used to do, you've got to learn how to invest even better than Warren Buffett does now. And let's go over Eli Lilly, and you all know that it's a drug company, and it discovers, develops, manufactures, and markets human pharmaceutical products. Okay, human stuff. Pharmaceutical segments include cardio-metabolic health, neuroscience, oncology, immunology, and others. And I wonder what the others are, but I'm sure they got other drugs in the pipeline. Top grossing franchises in 2024, and there's 4 or 5 names that I can't pronounce. But they're selling, and we're going to see that by the earnings, has 47,000 employees, so it's a sizable company. Now, here's the important stuff. Eli Lilly and Company ranks among stocks with low beta that can beat market volatility. That's so important. You want a stock that does good, that's a growth stock, but yet does not underperform the market when the market turns down. It's more of a defensive stock most of the time. Now, following the European Association for the Study of Diabetes, and here we go, this is the important stuff, Bernstein and their group affirmed its outperforming rating on Eli Lilly, so it's saying it's going to outperform the market with a $1,100 price target. Folks, that's $300 more than it is right now. And the GLP, here it is. This is it, GLP-1, GLP-1, and type 2 diabetes, that's what the GLP-1 is, and obesity. Folks, look at this, obesity. This is what's propelling Eli Lilly. Yeah, it's one of those weight loss drugs, and it helps cure type 2 diabetes, which so many people have. Okay, let's look at some numbers in here. Right now, we're looking at the clean surplus return on equity, and it's a different return on equity than traditional accounting. Much, much different. And the average stock, or the average stock in our database, which are all good stocks, 13.5%, Eli Lilly at 21.7%. How you think about this, folks, is if you had to put your money in a bank, would you put it in the bank that's returning you 13.5% per year or 21.7% per year? Yeah, not much of a thought process on that. Now, the net income, look at this. This is the 5-year average. Average stock 13%, Eli Lilly 37.8%. My gosh, it is just moving right along, isn't it? Almost 3 times more than the average stock. Now, revenue growth, well, folks, this is 3 times more than the average stock. Revenue growth for the average stock in our database, 7.1%, which is good. That's normal market growth. Eli Lilly, 21.6%. Nice. And now let's look at these numbers a little bit closer, and we can see that the net income has been was kind of steady in here, and then all of a sudden with the type 2 diabetes drug and the weight loss drug, this net income, which is the clean surplus earnings, just started going up, up, and up, and that raised the clean surplus ROE all the way up here to 33.3%. That's amazing. So when we look at the 3, the 5, and the 10-year average, we want to see this average going up. And folks, this is our kind of stock, and it is in our dividend growth and income portfolio, and it's doing very, very nicely in here with this kind of return. Now, the retention rate, 5-year retention rate has been about 58%. We like to see it higher than that. But look what it's been doing in the past 3 years. It's been increasing the amount of money that has been going back into it in order to increase its earnings. And has it been doing it? Yeah, you could tell that by the clean surplus return on equity. So they're retaining money, reinvesting it in the company, and it's working more and more efficiently all the time. Why? When the clean surplus return on equity rises, it means the earnings are increasing at an increasing or accelerating rate. That's why the market loves this stock, and that's why this one group is putting a $1,100 price tag on it over the coming couple of years. Now, net income growth, remember we just went over this, the average stock about 13%. This is going to be 30% for 2026. And the revenue growth, of course, 17.5%. Low debt on this. And this is Buffett's rule of thumb. How many, if a company takes all the money it's making, puts it back into itself in order to pay off the debt, how many years would it take? His rule of thumb is 5 years or less. Our rule of thumb is 3 years or less. This company can pay it off in 1.4 years. Very, very nice. It has a low dividend, which is what we like. We want to see money going back into it in order to grow. That's what this is all about here, folks. The net income rising very, very nicely over the past couple of years. Now, when we look at 5 years, black line down here, S&P 500 up about 98%. This stock up 499%. But with that $1,100 price tag on it, folks, this reached a high. This is Eli Lilly, the blue line, reached a high of a little over $900 a share. So $1,100 a share brings it up here. So when you look at up here versus where it is right now, and good news just came out on this stock. That's why we had this big rise right in here just the other day. And folks, they're expecting a price up here over the next year or two. So we'll see if it does that. That's a big move in a short period of time. But boy, from here, yeah, like I'm saying, this might be the buying time. Now you can see that over 1 year, black line is the S&P 500. Over 1 year, it has not done well. Why? Because they were fighting with this obesity drug and the type 2 diabetes drug, and they were fighting Novo Nordisk. Remember the name of that company? Yeah. And so this past year, the market didn't like it. But over 5 years, look at this. So you can see right in here, this is the last year, and you can see it has not done well over the past year. But over 5 years, look at it, and they expect a price up here somewhere at $1,100 a share. So, folks, we kind of like this stock, and it's in our portfolio. Been in there a long time. We've taken this whole rise in here. Very, very nice. So we like this stock, and we like it at this price, too. We just might put it in our growth portfolio. We're thinking about that, folks, with that clean surplus ROE at 30-some%. Yeah, we like it. So, folks, we had a pretty good week this week. The market reached nominal new highs just by a point or two, but that's okay. We'll take it. Yeah, the market is overvalued in here, and that's what keeps us worried a little bit. Partial government shutdown at this particular time for at least the next couple of days. But so go out this weekend, enjoy it, take your mind off the market, watch the sunrise on the beach, watch the sunrise wherever you are, watch the sunset too while you're at it. Be with your family, have Sunday dinner, that would be nice. But most of all, stay safe, and we'll see you back here in a couple of days.